Today's quiz is about earnings management and profit and anomalies. Question 1. A company capitalizes routine maintenance costs. This violates. The correct answer is option B. Question 2. Cookie jar reserves are primarily used to. The correct answer is option C. Question 3. The most reliable red flag for earnings manipulation is. The correct answer is option A. Question 4. A company reports 10 millions earning before interest and taxes but 6 millions in restructuring charges. Adjusted earning before interest and taxes is. The correct answer is option D. Question 5. Big bath accounting typically occurs during. The correct answer is option B. Question 6. Why might deferred revenue balances spike before quarter end? The correct answer is option A. Question 7. A firm with 50 millions revenue and 8 millions in one-time expenses every 3 years should normalize annual expenses as. The correct answer is option C. Question 8. The Security and Exchange Commission scrutinizes non-GAAP measures that. The correct answer is option D. Question 9. A sudden decrease in warranty liability as percentage of sales suggests. The correct answer is option B. Question 10. Managed earnings become fraudulent when. The correct answer is option C. Restructuring charges are typically non-recurring expenses, for example, layoffs, facility closures. Analysts often adjust EBIT to exclude these one-time items to reflect core operating performance. To find the adjusted EBIT, add back these non-recurring expenses. Adjusted EBIT equals reported EBIT plus restructuring charges. That is, add 10 millions with 6 millions. To get our answer of 16 millions. Important notes. 1. IFRS treatment. Restructuring charges re-expensed in the period they're incurred, reducing reported EBIT. 2. On the investor perspective. Adjusted metrics help compare ongoing performance across periods or companies. Since these 8 million costs are not truly one-time, they should be normalized to reflect the firm's true ongoing expenses. Spread the 8 million equally over 3 years. Why normalize? It avoids distortion in profitability metrics. Without normalization, expenses fluctuate wildly. With normalization, it smooths expenses to 2.67 million annually, improving comparability. It aligns with accounting best practices for recurring, one-time costs. So how was today's quiz? Please do let me know. Also, if you have any question, just ask me in the comments section. See ya next time.